Welcome to episode 61 of the Cocktail Investing Podcast, where we distill what's going on in the world around us into clear investment signals. I'm Lenore Hawkins, Chief Macro Strategist for Tematica Research, and this week, Chris Versace, our Chief Investment Officer, joined me in New York City, where we spoke with a woman who has some phenomenal insight into the world of exchange-traded funds, Yasmin Dahya from JP Morgan Asset Management. Now, you've probably read about the incredible proliferation of exchange-traded funds these days, and most investors have certainly heard about the brutal destruction of the inverse volatility ETF earlier this year. Today, there are exchange-traded funds that focus on everything from cybersecurity to natural resources, even to blockchain, alongside those that are based on the more traditional indices. Exchange-traded funds can be powerful investing tools, but like all investments, you need to know what's in them and how they're going to react to various market conditions. Our guest this week, Yasmin Dahya, serves as the head of America's beta specialist team at JP Morgan Asset Management. That is an impressive title, and you'll find out she's a really impressive person. Yasmin works closely with client advisors to position JP Morgan's growing suite of beta strategies solutions. Not quite sure just what that means? Well, then keep listening. Prior to her current role, she worked as part of the firm's exchange-traded fund product development team, focusing on developing the overall ETF product strategy and launching new ETFs across all asset classes. Now, that means that she has been in this biz for quite a while and has seen an awful lot, so she can give us insight into where it's been and where it's going. We hope you enjoy our discussion as much as we did, and don't forget to visit us at www.tematicaresearch.com. where you can find more on how it is that we look at the investing world. We'd also love to get your feedback on this podcast, as we're always working to do what it is that we do a bit better. So, without further ado, let's talk to Yasmin. All right, so here we are today with Yasmin Dahya of JP Morgan talking about ETFs, and they have become quite the hot topic. We've seen an incredible acceleration in the growth of the number of ETFs out there, which has been phenomenal. It's more ETFs actually out there now than there are companies. So with your perspective, seeing what's going on out there, what do you think is driving all this acceleration into this specific type of vehicle?
And there are 2 points in there. One is the proliferation of ETFs, but also the explosion in assets, which I think is year-to-date 2018, like 100 billion.
Yeah. Well, I think there's, to your point, a couple of things in there that are really interesting. So a lot of people talk about the growth of ETFs, and the growth of ETFs is certainly true. ETFs are now at $3.5 trillion. That growth, to me, though, is very talked about quite often. And, there's a reason why you're seeing a growth of ETFs. It has to do with the ease of the vehicle, the tax efficiency, the transparency, the intraday tradability for people who want to take advantage of that. But what I think is more interesting than the growth, because that's clearly been around for a while, is actually the innovation that you're seeing in ETF, which I actually think is helping promote that growth. So people often equate ETFs with market cap passive investing. For most people, those are synonymous. But to the point of new product development, product proliferation, some may even say, but I see it as actually just new innovation in the space. What's happening is ETFs are no longer synonymous with market cap weighting.
Right. So what you're saying is, early on, we would have seen derivatives of the S&P 500, the spiders, the Dow Jones Industrial Average, the diamonds, and different twists on that, correct? And that kind of gave rise to even sector-specific ETFs, like S&P, industrials, retail, that sort of thing. So very plain vanilla type of stuff. And one of my questions, just to kind of sneak it in, and I'll do this quite a bit, as Lenore knows, is we're seeing a lot of fee compression. Is that helping drive this need for innovation from ETF issuers?
I think those things are linked. They're not necessarily one and the same. So fee pressure is happening everywhere in investment management, and ETFs have been part of that, particularly given their leaning towards market cap passive, which is traditionally cheaper. But what I think is really driving the product innovation in ETFs is actually an injection of new thinking into the ETF landscape. So if you actually think about the number of new players who've entered ETFs in the last few years, it's quite impressive. Since 2015, 75 new entrants have entered the ETF market. What does that mean? They're bringing with them their investment capabilities, their investment insights, and they're building products based on those capabilities. What that has resulted in is the fact that ETFs, which had traditionally been more of an exposure tool, like described, have now translated into certainly still exposures, but also investments and a core investment tool. Why is that a good thing for clients? Because what it means is they're able to take advantage of the vehicle, but now they have more choice in the investment strategies that are actually in the ETF vehicle. It is no longer just market cap passive. There's active fixed income.
Right.
There's alternatives. Yeah. There's a whole category of products that's referred to as smart beta or strategic beta.
Now, when you say alternatives, what do you mean by that? Because I think when we hear alternative investment strategies, the knee-jerk reaction tends to be long-short. Is it that, or is it something else?
That's one style of alternative. So something that's differentiated between your traditional asset classes, equities, and fixed income. The challenge that you're getting at with alternatives is that it's a very broad category. Yeah. The types of strategies and alternatives vary quite a lot. And in fact, that is one of the reasons why folks sometimes find them frustrating. The dispersion of returns are very different. It's hard to do due diligence in all these differences. But types of strategies you may see are equity long-short, market event-driven type strategies, managed futures type strategies. I personally think if I look at the market environment today, that this category has a lot of benefit that clients should be thinking about. If you look at where we are in the market cycle, 9 years into a bull equity market, 35 years into a bull fixed income. Favorite topic, I'm sure. What do you need? A diversifying return source that's differentiated relative to your traditional equity and traditional fixed income exposures. Right. But to tie it back to ETFs, what I find fascinating is that for all the proliferation that people talk about in ETFs, there actually are huge gaps that still exist in the market, and alternatives is one of them. So a couple stats.
How so?
The stats are amazing. If you look at the multi-alternative category, which I think of as like a core alternative holding in your portfolio, there are 8 ETFs in market. 8. Now, when you compare that...
Yeah, what do you those 8? So give me examples of what you mean.
Well, we have one market, JPHF.
Yeah.
When you think of multi-alternative, what that really means is a core alt holding that you can sort of use without, you're not really tactically timing it. Okay. It's a Morningstar category.
Got it.
There are 16 times more funds in that same category in mutual funds. So if you're a mutual fund investor, you have a ton of choice for your core multi-alternative holding. If you're an ETF-only investor, you don't. So what does that tell me? There's a need for more innovation in that space. It's not just new product, it's new product targeted at gaps.
Why the gap? Such a big disparity. Any particular is it just because some of those mutual fund managers might be starting to say, "Oh, we need to issue ETF strategies," and that gets back to my
reporting also is limiting too.
Yes.
I think the reporting becomes very challenging since you kind of know every day.
Yes, there's a whole host of reasons for that, and you're getting it.
There are some new tools that are being implemented that actually allow for a lagged reveal on what the portfolio has. And I think the guys and gals at the New York Stock Exchange have one such offering,
right? And
then some other active managers like Advisor Shares, I think Noah and his guys, they have something like that.
Yeah, there's a whole host of regulatory proposals that get at this transparency issue. My hypothesis on alternatives is a couple-fold. First, it goes to the point I was making about all the new entrants coming into the ETF market. If you rewind back 5-10 years ago, there was a lot less people playing in ETFs. What does that mean? Less innovation from the investment management perspective in categories like alts making their way into the ETF landscape.
And they were viewed much more narrowly. It was just
it was more exposure.
It was just exposure.
Secondly, I think maybe the macro environment had something to do with it as well, which is your equity and your fixed income parts of your portfolio have been historically doing so well. Maybe the need for an alternative from the perspective of a client was lower. And then third, the transparency issue is absolutely real. So when I put my product development hat on from an ETF lens, anything you put in an ETF needs to be able to be tradable and liquid from a market making standpoint, and you have to be comfortable with daily transparency. So there's certainly some strategies that don't make sense in an ETF. For example, you can't put distressed credit in an ETF. It's not liquid enough. But there are a number of hedge fund styles, for example, like equity long-short, event-driven, managed futures, which are implementable using the ETF vehicle. And as long as you as a manager are comfortable with daily transparency, which we are in those categories that we operate in, we implement in a systematic fashion, you can put them in an ETF. And so you are seeing more innovation in that space. One interesting stat I read from Cerulli was that advisors see that as a top product category where there is unmet demand. So I expect you will see more innovation within the alts category and ETFs, a place that I think has been historically underserved from a product development standpoint.
What are some of the other areas that are kind of underserved, or are there areas you think that are kind of ripe for development, as you said down at Insight ETF, for the 2.0ing of ETFs?
Yes, I am so excited about fixed income. And I think that there's that's a really, really enthusiastic response there. Nothing makes me more excited than fixed income. I'm really...
I knew I was going to enjoy this.
For the listeners out there, you heard a mental eye roll just now.
Gosh, maybe I overemphasize, but I really am. I'm very passionate about this space because I talk all the time to clients across channel. Yeah. And one of the things you hear from clients is, I like active management in fixed income. I think there's a value of active management in fixed income. But when you look at the ETF market, only 10% of the assets sit in a category that's either fully active or smart beta, strategic beta, which is non-debt issuance weighted.
And fixed income, there's so much room in that market to improve the efficiency. I mean, there's so much black box that still really occurs. You can't easily just trade bonds the way you can go trade shares of Apple. And for the individual investor, that just leaves a lot of room to improve that market and to give them access to a really valid vehicle.
Yeah, and a lot of people see fixed income ETFs as a huge, the likelihood of growth being quite high in that space. I'm particularly interested in the non-market cap weighted spaces. I think fully active fixed income, it exists in ETFs. We've launched a product in the category. I think you'll continue to see investment managers bring their fully active capabilities into the ETF arena. I also think there's a lot of space for, you mentioned the 2.0 of indexation, for improving upon traditional debt issuance weighted indexes. I mean, if you think about it, it's kind of insane.
Just for the listener, can you just explain what you just said?
Yeah, so there's traditional benchmarks out there. Market cap weighted is traditionally how it's referred to. They were a huge innovation when they became investable because they made the market broadly accessible to investors. But what you can see is that there's been decades of research that has happened since those products became investable that now can be incorporated into indexes. That's exactly what you're seeing in this world of smart beta, or we call it strategic beta. It's rules-based processes, but those rules do something different than market cap, with the belief there's a benefit from either a risk and or return standpoint.
What would be some examples of those rules?
Yeah. So a good example of a rule in the equity space would be using something like valuation. So as opposed to holding the whole market, just the whole market cap, you'll look for companies with good valuation. The other innovation that's happening is not just a single characteristic being thought of, it's actually putting those other characteristics into one uniform screen. So good valuation, but also good quality companies that are showing good momentum. So you're kind of thinking about, how do you actually pick stocks that we believe will outperform the total market cap?
And getting back to something you said earlier about liquidity, you probably have some trading screens as well.
Oh, of course. And I think that's an important element that sometimes gets overlooked, which is the devil's in the details when it comes to these strategic beta or smart beta products. They all may sound the same, but when you look under the hood, they have finer details that make them quite different. So I think due diligence really matters.
I agree. I mean, that's, for example, when you look at two cybersecurity ETFs, Cyber, CIBR, and Hack, their holdings are different, their weightings are different as well. So you really need to understand, to your point, what it is you are buying.
Yeah. Now, in the fixed income space, why I think there's a huge opportunity there is sort of, if you think intuitively, we just talked about using something like valuation or quality or momentum in picking equity securities. Think about the credit spaces. You own something that is issuing more debt, and you get more exposure as it issues more debt. That's sort of counterintuitive if you think about it. So the opportunity to move away from that is quite high. Now, you've seen a lot of innovation in the equity space, in the smart beta, strategic beta equity. Those assets are now at $700 billion in ETFs. They are not a small category. I think the next wave is going to be rules-based processes that do something different than traditional debt issuance-weighted indexes and fixed income being brought to market to help solve some of these problems and deliver, I believe, better investment outcomes to clients.
Do you think, I understand intuitively what you're saying. I'm just thinking about what Lenore said earlier about how the individual investor has they don't have an opportunity to buy bonds for the most part, right? But on the other hand, I'm listening to you and I'm thinking, this is great. But the average investor is going to hear everything you just said and be like, this is great. Oh my God, what do I do?
What do I learn?
Yeah. So, I mean, it's a great opportunity for a product to simplify it, but I still think there might be an issue that, like to your point about diligence, to the individual or to the RIA, how do I understand what this is? How is this different as I'm doing different things? How do I roll up my sleeves, get comfortable with this? From Tematica's perspective, we're content first, and it seems to me that you need to have smart content to help pave that acceptance.
Yes. I think the adoption question is really important. One of the things, not even just at the end client level, I think about the advisor level.
And the wholesalers.
Like, how is there going to be adoption of these non-market cap weighted products?
What have you seen that works?
Helps
like
to break through.
Yeah, for these ETFs, because there's such great research out there that has shown that certain strategies really do help you get better returns. But how do you explain that?
How do you explain that? So I think there's a huge body of work that's happening, but needs to happen further on the education front. So, for example, what is factor investing?
Yeah.
We use a lot of terms that sometimes don't mean anything to people.
Sounds very
sexy. How do you break it down? What is factor? Yeah.
I like factors.
And so you layer upon more and more terminology.
Like
you complicate it. So what I like to talk about is, well, what are you solving for with market cap? What are the opportunities of, if you could change the rules in your index, what would you change and why? What comes to mind for me are really two things when we think about our opportunities at JP Morgan. The first is concentrations of risk. If you think about market cap, the whole point of market cap was I want diverse exposure to a basket of equity securities. Let's say if we're talking about equity market cap. But if you actually look at the way that market cap works and the weighting mechanism, you're prone to some very extreme concentrations of risk. So here's an example. Over the tech crisis for that 3-year period, 40% of the risk of a market cap US index came from technology. So you were not actually diversified. And we see that if you just turn on the TV and look at the news, we hear a lot more about that, about individual stock concentration right now. So if you can change the rules in your index, why not be more diversified?
What was the stat you were talking about today?
Oh, that since 2014, there's been just 7 stocks in the S&P 500 that have accounted for over 40% of the returns. I mean, talk about concentration. There's NVIDIA, Amazon, Microsoft, Netflix, Alphabet, and Facebook. I mean, that talk about concentration. You take those suckers out, and
did you get the return? And I think concentration is another topic I care a lot about. It's not to say that concentration is a bad thing. I think that is a role of an active manager to actively due diligence securities in the portfolio and sectors and regions and make those concentrated bets. But what's happening is that often investors are inheriting that concentration just as a result of market cap. And so, and the weighting mechanism that there is. So in my mind, if I think about why you would do something different in your index construction process, what is the value of the 2.0 of this index? Number one is, if you're trying to be diversified, actually be diversified. That's one way to explain it.
I ran into that problem when I created this NJCU New Jersey 50 index to represent the New Jersey economy. We did it with S&P Dow Jones, and they were like, we'll just go a straight market cap strategy. And then we did that, and J&J, Johnson & Johnson, was some ridiculous percentage. So you might as well be effectively buying, just go buy J&J is what it said. So we actually had to cap the weightings, and I think we wound up capping at 4%, so we could get even distribution across the other 49 names.
That's actually one of the core parts of putting, again, my product development hat back on, of the value proposition of our indexes, is that you are diversified across actual stocks in the portfolio. You don't have one particular name dominating. Let the role of concentration be something that someone's actively choosing. Let your active manager do that. Or you yourself, if you have a strong view on a stock. Don't inherit that because of the way that the index construction works. I also think that the word factor investing, what that implies is decades of research around characteristics that people believe will enhance return. I mentioned value, quality, and momentum. There are ways you can employ these screens to identify stocks that over long periods of time we think will outperform the market cap. If you know that body of research exists, why would you not have that in your index construction process? So I think that's another element that people have to understand is you're just incorporating investment ideas that are already out there. You're really updating your index is the way I think about it.
Yeah, so it's interesting. Those 3 characteristics, as someone who used to be in Wall Street equity research, value, quality, those can mean different things to different people. They can mean different things to different sectors as well. a sector that might be wildly expensive, well, compared to another one, it could be not cheap, but relatively inexpensive. So how do you wrap your head around those differences?
That's a really important point. And I think one of the things we're seeing is clients are now getting one level deeper into those types of questions. So first and foremost, you're absolutely right. One of the challenges that exists with the factor investing landscape is what exactly is the definition of value? And you'll find that from provider to provider, index provider to index provider, they'll be different.
And most of those are spelled out, sorry, just for information, those tend to be spelled out in the methodology document that goes along with
You can look them up.
Yeah.
And that's actually one of the beauties of strategic beta is that it's transparent.
Yeah.
Right.
There's a rule book on a website somewhere for you to read to understand when you say...
Keyword being somewhere.
Somewhere. We actually are very transparent about where it is. It exists. And I like that because what it takes is the black boxy element away from this idea of systematic investing. You can know how someone's defining value. So I would encourage people to look at that. One element we believe in very strongly when you're thinking about quantitative models is you don't actually want them to be dependent on very small parameters. So I personally think when it comes to definitions, a broad, diverse sub-definition is really important. The second thing I would say to your point of comparability across sectors, that's a really big one. It's whether you're comparing sectors to each other, so stocks within the same sector or across. And that's another methodology difference that exists. So one of the challenges with this space that I think we really have to admit to ourselves is that within that $700 billion of assets I mentioned, the ways in which people are building their products, the outcomes that can be delivered are very dispersed. So that is a hurdle for due diligence that I do believe exists out there. But on the flip side, we are now seeing these products gain more live track record.
Right.
So as opposed to relying on theoretical back testing, which is everyone's favorite word, but for anyone who is not familiar with it, what that really refers to is knowing the answers to the test before you take it. You basically create the most perfect investment outcome based on the data. That's people's fear of the space.
Yeah.
That is the worry of backtesting, but now there's live performance that you can really square away against that to understand, is the product doing what I thought it should do?
So when you talk about backtest, you just put on your product development hat. If somebody comes to you with an index and they go, look at this backtest, meaning looking at the performance over the past several years, whether it's 5 years, and we've seen some requests up to 10 years. Wow, this is the best thing since sliced bread. It beats its benchmarks and blah, 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 blah. Does that make you a little nervous that it is so perfect?
Well,
The survivor bias.
well, no one's going to ever show you a bad back test, and so I don't think that I don't think that it's a problem that back tests look good. What I push on, and what I think investors should push on, is why do you believe that performance is on a forward-looking basis sustainable?
Are you saying that past performance is no indicator of future performance?
So the way we talk about it actually is, and when you think about the world of systematic investing, it's first and foremost, what's the economic rationale for that outperformance? Or another simpler way of saying that is why does this exist?
Yeah.
What is a reason why we believe that something like value will be positively persistent performance in the future? And so understanding the rationale before you look at the data is how you prevent the worry of data mining. If you start with the data first, if you give someone 10 years worth of data, they can find you a trend. The question is, will that trend be on a forward-looking basis, something that will persist? So you've got to start with the theoretical first.
Sounds familiar, does it not?
Yes, we just discussed this a lot with the utility of back testing and how meaningful that is. Is this a trend that's going to continue? Is this a theme that has legs going into the future? And
I don't want to discount the back test totally. One of the things I do think is really valuable is understanding, or it's really performance expectation setting. What do you expect a product like this to do in different market environments? So it gives you some information to do some analysis to understand those things. But if a researcher is sitting in front of you, you should really push them not so much on just the data, but on the why. Yeah. Why does that happen?
What was the factors involved?
So one of the conversations that we have quite a bit with our themes that we're noodling and working on some things with is one is what we call the boomer economy, which deals with the impact of the aging population and what their evolving, changing needs are and how those will be met over the next 5, 10, 15, 20 years. Very different than what baby boomers were doing 10 years ago or 20 years ago.
Yeah.
So it's very much a forward-looking investment theme that, if we were to backtest it, the question becomes, do I go back in time and do what the baby boomers were doing 10 years ago before this massive pain point actually came to fruition?
Well, it's like doing a back test on cybersecurity that goes back 10 years. It just wouldn't
Didn't exist.
It
It
wouldn't
doesn't
be
exist in the
meaningful.
same way.
Yeah.
And those I would put in the bucket of thematics and the idea of providing access to something.
Thematics?
Oh,
You mean kind of like what thematic
have I heard
stands
that word before?
Wait, what?
That is a huge trend in ETFs that I think is really exciting, is that there's been so much product innovation in the thematic space that people now can express their view. If you have a view on cybersecurity or an aging population, you now have a tool to actually do that. And that is one of the utilities to me of an ETF, is that it's the product development has brought some really useful, timely products to market.
I'm not going to get my back up too big on this, but I would say that I think we're going to see a change in thematic products, because I think some of the ones that are out there, like when we were at Inside ETF 2017, we were talking with an ETF issuer, and they were like, yeah, we have thematics, we have wood and water. And, given the way that we look at thematics, which I think everybody at Team Thematica can recite what I'm about to say in their sleep, which is we look at the shifting landscapes of economics, demographics, psychographics, technology, and a few other factors. So a really evolving landscape. That's not really water and wood, right? So I think we're starting to see a
different definition of themes, of investing
Yes.
in themes.
Yes.
That it's not a theme that is just some sort of environmental view or some
don't get me started on ESG, please.
That is the hard thing with that space altogether,
Yeah.
is like, how do you define it? And, it is sort of in the eye of the beholder.
And it can
to
be
what,
bewildering to the investor. I think that's one of the toughest things for the investor, is this industry has a tendency, because it can be very complicated. It's tough in this industry for us to not have jargon that can be kind of off-putting or confusing for the investor, particularly. And I wanted to ask you a bit about if you see some concerns out there with ETFs such as the inverse VIX and how that blew up so spectacularly that maybe not everything is really appropriate to be set up in an ETF that is accessible to an individual investor. What do you see going on in the industry discussions with things like that?
Yeah, I think that's a really important point, which is, first and foremost, when you're thinking about your product strategy, I'll just say it from the lens I sit in. You really have to think about who's the buyer and is it really ultimately appropriate for them to buy it. So we wouldn't launch inverse or levered inverse products like that. And my worst fear is that people are going to be caught off guard. So ultimately, I don't think any of these conversations are just product conversations. I wouldn't want someone just buying a factor product without the commensurate education that needs to go alongside of it. So when you're buying, for example, another one that may pop to mind is when you're buying like a low volatility or a single factor ETFs, there's a great use case in a portfolio for those types of products. But you have to be buying it for that specific reason, and you should know why. So to me, there's that I think the problem of product development is not so much that the product development itself, it's just it has to come alongside with the education with it. ETFs, the dispersion of the types of ETFs out there are quite wide. But I do think that for certain types of products in particular, there has to be more education on what they're supposed to do, so you're not surprised.
Kind of following on that, we're seeing over the last couple of months a lot of, I think, what we would call fad ETFs kind of come out. Where we've seen
very focused. I mean, they're.
Well, I mean, they're ones that are like focused on marijuana, focused on blockchain, and I think some of them could be very good products over the long term, but there could also be some of them that are kind of, I don't want to say cashing in, but they're looking to really leverage the buzz around blockchain today. And they may not have like a long life perhaps because of that. And we've seen some other ETFs in the past that have kind of had to pivot their strategy because of that.
Yeah.
So I'm just wondering, how, I guess, so what's the question, right? How do you look at some of these things that might be faddish versus something that, again, as a product development person, that has legs?
Yeah. I mean, I'll answer it from my point of view on this, which is ultimately that I believe in the investment rationale behind a product. So what is the investment thesis? And that may coincide with a theme that may be exciting for someone, but it really first and foremost is what's the research elements of it. I think in the end of the day, whatever you're owning, you own an investment. You own stocks or bonds in a portfolio that go up and down. And so I sort of believe investors do have to look under the hood beyond just the label of something, because to your point you made earlier, what you may find is two ETFs, or two, not even just ETFs, two investment products with the same name, like cybersecurity, could be doing very different things in the portfolio. They may actually not look that much alike. So ultimately, while it seems simple to just buy off the shelf a word that resonates, it's an investment product that has investment implications.
Yeah, I mean, you're saying the same thing that we say all the time about economic data or industry data, which is you can't rely on the headline. You've got to, roll up your sleeves and get into the details. Yeah, absolutely.
With so many ETFs out there, and I mean, just an explosion in the number, do you think it's likely that we may see some consolidation in the future, particularly as there's more and more pressure on costs?
Well, you certainly see a lot of openings, but also a lot of closures of ETFs. So thinking back to last year, there was something like north of 250 ETF launches, but over 100 closures. So that's a common theme that you see. Ultimately, when I think about what we would want to bring to market, it's long-term investment products that we believe has a core strategic allocation in a client's portfolio. So from that point of view, those have a lot of runway and a lot of life shelf. For other product strategies out there that are more quick to market, timely, faddish type of strategies, I think that's a really important point, is how sustainable is that business model. And there are a variety of different approaches that people are taking with their product strategies to market. But ultimately, the ones I believe that are more investment driven and target a core holding doesn't really have that same timeliness to it. But I do think that it could be unsustainable for some products to live that don't gather assets, right? You do see a lot of small ETFs out there. And ultimately, if they don't have a place in a portfolio, they really can't kind of live on, can they?
Circling back to something we said earlier, there could be really good products that just don't make it. They can't gather the assets, as you said. What, in your experience, what's one of the bigger factors for that failure? Even though it is a good strategy, is it not being communicated correctly, like we talked about, to individuals, wholesalers, RIAs, what have you, or is it that and something else?
Well, why don't I walk you through how a product development process from my lens, which is that when I think you first build a product, for me the most important thing is there an investment capability? If you say yes, that doesn't mean it necessarily needs to be a product you bring to market. Then you have to go out there and look at, well, in the landscape, is there something I'm bringing that's unique with a value proposition that fills a gap? So for me, that alts number just sort of screams out of like, gosh, there's unmet demand here. There is a value in bringing that. And then you want to survey the market, and you want to go talk to clients and understand from them, if I brought something out like this, what would be your reaction? Is this actually a need that you have? So that insight I said about clients liking active management and fixed income is because you go and talk to clients and ask them what they want. Those to me are the pillars of a good, strong product development process. Is, do you have an investment capability? Does it meet a demand in the market? Have you surveyed that? And is it also importantly fit within an overall product strategy? That helps to prevent I completely missed the mark moment of, I thought there was a buyer and there wasn't a buyer. And I think then you have to have follow through beyond that, which is, if we talked about education being a really important point of the sales process, you need people in the ground helping their clients understand that. So we, for example, spend a lot of time around with our factor-based strategies. How do we get to the advisors to help them understand what factors are, why they make sense, where they fit in a portfolio? It's not just product that's important. It's then the people component and the education component.
Right, absolutely.
Showing them where it fits.
Where it fits is the most important question I think that we get all the time. And I view it not just as education, like I mentioned, it's also technology. I think there is a huge trend we are seeing, which is, how do we put on the desktops of advisors technology tools to help them understand their portfolios better, to identify those gaps. So, for example, I think one of the adoption hurdles of factor investing is, how does someone know what factor product to buy if they don't even know what the factor footprint of their portfolio is today?
Yeah.
It's like you're coming with the solution without diagnosing the problem. That is changing because there are now an advancement in the technology tools that exist out there to help advisors identify those factor gaps. That is when you'd maybe have a factor conversation. So I personally believe where it fits in a portfolio is a very important place to start with the client conversation, and I think technology is actually going to advance that conversation even further.
Yeah, it's incredible what technology has done to change the way people interact with their own investments, interact with their own investment advisors, and helping advisors provide a much higher service. So along with that, what else has got you really excited in this space?
Yeah. Well, I did say alternatives is a big category. Fixed income,
got me excited.
Clearly glowing about. Maybe to build out the alternatives piece a little more, because I think that is one where I do feel particularly excited given the market context. There's a whole body of work around the cost associated with buying alternatives. And I think that ETFs to me stand for democratization. If you think about them, they're accessible to everybody, right? And that is philosophically one of the most exciting things to me about ETFs. Similarly, there's a whole vein of investment processes that are happening right now in alternatives, which is how do you take what used to be only accessible to people with enough money that were willing to pay high fees and make it actually accessible to the end investor. Exactly. And in that sense, it's called alternative beta is one of the words used for it, but it's using systematic processes to deliver in a low cost and transparent way access to diversifying return sources. Why I find that exciting is because if you take that investment philosophy, which is democratizing, and you put it in a vehicle, which is democratizing, you truly are doing what I think is a really profound thing for clients, which is providing real access to things that historically were only accessible to the largest pools of capital in this world. And that is very exciting to me. And I think that's very consistent with the theme of ETFs, which is, delivering investment exposures in a low-cost, transparent, accessible way.
So if we were to look 3 to 5 years into the future, gaze into your crystal ball, how will the ETF landscape be different then compared to today?
I think that theme of ETFs don't equal market cap passive is already broken, but it will be even more apparent in 5 years from now that is the case. So I think you'll see a continuation of that trend, and it won't just be in the smart beta, strategic beta, equity world. You're going to see the fixed income world get disrupted in that same way. The alternatives I've clearly talked quite a lot about. The product set that exists out there for clients will look different than it did 10 years ago, and that will be more investment-driven exposures. I think that's number one.
Okay.
Number two, I do think technology is going to really be very disruptive in this space, whether it's the way in which asset managers are using data to bring products to market, or whether it's the client idea of measurement and technology tools to understand their portfolios. It's not just going to be a product conversation. It's definitely going to be driven by a technology conversation. And I think those tools will be more accessible. The last thing I'll say is I think a lot of these words we're using today, like strategic beta and factors, they'll actually mean something to clients in 5 years. I've already seen in the last 5 years a real depth and understanding of the space. I think there's a huge acceleration in what people know about these non-market cap weighted indexes, and I see that definitely continuing in the future. So I think you'll just see more comfort with that.
So earlier you made the comment we're 9 years into the bull market, right? And Lenore has said ample times, not today, but in the past, that we are how many years into the current expansion?
We are 107 months.
Yes, which is the second longest.
Yep, second longest.
So I guess the one question I would ask is, we've seen a huge inflow in ETFs like we talked about, just year after year, improvement. What do you think happens when we hit that bump in the road that is either, a bear market or a recession, and we see the market do what it does in those times? Do you think the ETF market will help? ETFs will help the market be more resilient, or do you think maybe not?
I may answer that from a slightly different perspective, which is non-vehicle.
Do that, because when I get a question I don't like, that's what I do.
Not that I didn't like it. I just loved it. But what I think about is that goes back to the confluence of ETFs and market cap. Ultimately what's going to matter when things get more volatile, if things get more volatile, is what's in the portfolio. What is it designed to do, and how does it handle that? And is it doing what you expect it to do? And there are strategies out there in ETFs that weather well in volatility. There's, for example, low volatility funds that are targeting low volatility securities. I would even say some of the things I was talking about diversifying risk. There's strategies out there that do things like that. Those are, I think, prime for a type of market environment where you see increased volatility. What was easy last year was owning just the market. Right? That was just easy. Yeah, that was easy. You didn't really need to think too much about the intra-year drawdowns that you historically see in the equity market. Now, if we move to an environment like that, and the last couple months has been indicative of something like that, people, I believe, it won't be just easy to own the market, and then it will go back to what's in your portfolio. Have you created a portfolio that is designed to withstand that type of volatility, and can you stay invested?
Okay, now we're going to ask you the last and most likely the single most important question, or at least we at Cocktail Investing consider it the single most important question, is favorite cocktail.
Ooh, I'm a wine drinker. Does that count? All right, let me answer the question.
So what
gin
what
and
wine?
tonic.
I'll
go gin and
knew
tonic.
I liked you.
You know, when it's a hot day outside, and you're just sitting out.
Particular favorite gin?
Oh, now you're asking hard questions.
Okay, that's fine.
Just
Just a good gin and tonic.
Just little mint in there,
Sure.
maybe like a little nice flavor Pellegrino.
Yeah, I don't make it as fancy, but
So, what kind of wine?
I like red wine.
Yeah.
Basically, all kinds of
All
red
kinds.
wine.
Well, spending a lot of time in northern Italy, right in the Barolo region.
Oh yeah,
Yeah, I'm so
that
spoiled.
sounds good.
Oh,
I wish you'd brought some along today.
yeah, I probably should have. We need to think of that as Cocktail Investing podcast along the cocktailing side.
Yes, I think. Well, we've talked in the past about taping a podcast over cocktails.
Yeah,
Yeah.
that's
But
something we
that-
ought to shoot for.
I think so.
Could be an interesting listen.
So maybe we'll have to have Yasmin back.
Yes, I think we're going to have to
I'm
definitely.
coming back for it, I think.
for the Cocktail Investing 2.0.
2.0 podcast. That's right. That's
Well,
right.
thank you so much for your time.
Yeah.
And thank you, everybody, for tuning in. It was a pleasure.